big problem comes into play is there is going to be a massive wave of people who have to owe all of that amount of money they didn't pay. Remember the $1,000 for those 60 days? Imagine going 9 months. That's $9,000 you owe at the end of the forbearance period. How many people right now in the crisis that we're going through do you think have that money to pay that? Welcome, guys, to the Deviant Core Podcast. I am your host, Drew Dukes, and today we are going to talk about a lot of stuff that's been going down, including some breaking news in the financial market. So let's go ahead and get into it. But before we do, go ahead and head on over to our listening platforms at Apple Podcasts. We're also on Spotify. We're on Overcast, Stitcher, and as an added bonus, we just got on Amazon Music. So for those of you guys who love listening to this podcast on those platforms, head on over there and show me some love, help us grow, and let's get at it. We're also offering videos and clips of this podcast on YouTube at The Deviant Core and on Facebook at The Deviant Core Podcast. So head on over to those platforms, follow those pages, like it, share, and let's go. So today, all right, we got breaking news in the finance market. Essentially, what just happened is that a bunch of banks got exposed in a massive money laundering bust or scandal. There's no surprise that Deutsche Bank being one of them, but the article we're going to go into is going to explain a lot. And before we get into that, I just want to let you know that these investigations that that were performed did happen over the span of years, and even some of them that were leaked we already know. So we know, like for instance, we already know that Deutsche Bank's on the list, but some of the scandals that were involving them, doing business with countries that we actively had a U.S. sanction on, or doing illegal money laundering transactions with either drug cartel members or other shady groups. So we've already known that, and we heard that over the years. In fact, in my last video, I explained why part of this and what the scandals that they were going through is included in some of the losses that they experienced back in 2019. This was a big portion of it. So getting to a story here. Deutsche Bank tops the list of suspicious transactions amongst leaked U.S. government files. Germany's largest lender, Deutsche Bank, appears to have facilitated more than half the $2 trillion of suspicious transactions that were flagged to the U.S. government over nearly 2 decades. That's $2 trillion with the T. 2 trillion. Documents showed that between 1999 and 2017, $1.3 trillion of the $2 trillion leaked in transactions were flagged as suspicious, passed through Deutsche Bank, according to DW. It said BuzzFeed News obtained the files and shared them with the International Consortium of Investigative Journalists. The leaked documents contain suspicious activity reports that banks and other financial institutions filed with the U.S. Department of Treasury Financial Crimes Enforcement Network, or FinCEN. Financial firms are required by law to alert regulators when they detect activities that may be suspicious, such as money laundering or sanction violations. Such reports are not necessarily evidence of any criminal conduct. Now, what I want to show you guys is the map over here, right? Take a look at this. Take a look at this. This is the graph. They graphed all this out. So for those of you guys who are listeners, I'm going to explain the graph. They have the graph of the top 5 or 6 banks here that were involved in these money laundering schemes. All right. Out of them, you have Deutsche Bank, JPMorgan, Standard Chartered, Bank of New York Mellon, Barclays, Societe Generale, and HSBC, right? Out of all of them, this graph just shows how much of the load Deutsche Bank has. I mean, look at this. This is ridiculous. $1.3 trillion of that crap. Now, let's get into why this is incredibly important, right? Because not just for Deutsche Bank, but for all the other banks that were caught amid this. It's because Deutsche Bank holds the largest amount of derivative, about $49 trillion worth of derivatives. And Deutsche Bank and their whole crew have been struggling to figure out how to unload all of these assets, because they know for a fact that these assets are at any point in time could go bust. And in the last video I did regarding this, we were talking about the commercial mortgage-backed securities and how that market's crashing as we speak. We also talked about how we believe that Deutsche Bank might be the next Lehman Brothers. We talked about all that. So added in with the massive scandals that they're under, the stock prices dropping like freaking flies, we can see that we are headed towards a point where these guys might be the catalyst for the destruction of the global financial system. And having scandals like this does not help. Couple things here. We're in a situation right now where we understand that employers are looking at the value of having their employees work from home. They're starting to realize that value now. We're also going through a period where we understand that basically businesses, malls, all these retail spots that used to be bustling and hubbling when things were good are leaving. They're going bankrupt. They're done. So these spaces aren't being filled. Landlords aren't getting paid. And because they're not getting paid, they can't pay their mortgages on those commercial properties. Let that sink in. Now you have banks, middlemen banks like Deutsche Bank, right? And they partner with a lot of investors who bought in to a lot of these assets right now that they're essentially going bad. They bought into all of this stuff. It's crashing. These guys are going to get wiped out along with this bank, which is going to take down the entire system. And yet they're being caught up in scandals just like this. I just want y'all to pay attention to that. And this leads me, this is a perfect segue into the next article, because the next article talks exactly about how this all is going to go down. Now, this is a opinion piece from Market Watch. Now, COVID-19 lockdown is squeezing the real estate from all sides. This threatens to burst the housing and mortgage bubble. Recently, the Federal Housing Finance Administration, FHFA, conservator Fannie Mae and Freddie Mac extended the moratorium for both evictions and foreclosures until the end of the year. Many homeowners breathed a sigh of relief. Indeed, over the past few months, the number of borrowers with active forbearance has declined, but that's no reason for optimism. The more serious matter is how many homeowners are now delinquent. By the end of 2020, several million borrowers who have received mortgage forbearance will have gone 9 months without making a mortgage payment. What impacts will this have on the U.S. housing and mortgage markets? Let's start with the FHA insured loans. According to the HUD study July, Neighborhood Watch report dictated that 17% of 8 million insured mortgages are now delinquent. This percentage includes mortgages in forbearance as well as those not in forbearance. Hard-hit metropolitan areas include New York City with 27.2%, Miami with 24.4%, and Atlanta with 21%. Let that sink in, folks. Let that sink in. Okay? So we're in a situation around where now obviously mortgage-backed securities is a little bit different from commercial-backed securities that we're just talking about with Deutsche Bank. But it just goes to show you how unhealthy this economy really is. All right? For those of you guys who don't know what a forbearance is, let's say you got 60 days, right? You got 2 months, right? And for 2 months you can't pay your bill, and your mortgage is about $1,000 a month, right? So you go to your bank, you say, "Hey, Mr. Bank, I need help with this bill right now. I can't pay it. Do you mind if you can defer this loan?" and I can pay it at the end of this 60-day term. So the bank writes up 60 days, and then they say, okay, you don't pay your mortgage for 60 days, but at the end of the 60 days, you owe me $2,000 up front. That's how it works. It's essentially a mortgage deferment. Now, what's been going on since this entire pandemic has broken out is that people couldn't pay their mortgages. People couldn't pay it because they were out of work. So what happened is a lot of people filed for forbearance. Those who were insured and those who were uninsured. They filed for mortgage forbearance, which basically deferred all their payments until we could figure out what was going on. Now, when we all got the stimulus package with the CARES Act and HEROES Act and things like that, this basically came in and extended the eviction moratorium. So basically, landlords and banks and stuff like that couldn't get rid of tenants who weren't paying, and they extended it to the end of this year. Now, here's where the big problem comes into play. The big problem comes into play is there is going to be a massive wave of people who have to owe all of that amount of money they didn't pay. Remember the $1,000 for those 60 days? Imagine going 9 months. That's $9,000 you owe at the end of the forbearance period. How many people right now in the crisis that we're going through do you think have that money to pay that? And that's just $1,000. Your mortgages, I've seen mortgages go for crazy amounts because the housing bubble was already inflated. We reinflated the whole thing. You know, that Dodd-Frank that Obama did and all the other guys did, right? That Dodd-Frank didn't work because we're back in the same circle. We reinflated the bubble for the housing market. Now, an unexpected crisis like the COVID threatens to demolish all of that. There is going to be a forbearance crisis. On the positive end, those you guys who were smart financially and you want to hold out, in the next couple years, you're gonna find some pretty good deals. In fact, this article continues here. At the peak of this activity in late 2007, more than 10 million of these mortgages were outstanding, with a total debt more than 2.4 trillion. As recently as early 2018, 25% of all delinquent borrowers nationwide had not made a mortgage payment in at least 5 years. In New York State, New Jersey, and Washington, D.C., that percentage was more than 40%. Keep in mind that these extremely high delinquencies rates existed well before the COVID-19 pandemic erupted. Since March of this year, the delinquency rate for subprime mortgages reversed a 10-year decline and climbed to 23.7% in July, according to TCW most recent mortgage market monitor report. Other subprime bubble era mortgage delinquency rates also were substantially higher. According to the Inside Mortgage Finance, mortgage servicers had erased the pain for owners of these non-guaranteed mortgage-backed securities by advancing delinquent principal and interest to them, but in TCW's latest report, nearly 1/3 of these delinquent payments had not been advanced to the owners at the end of July. That means they're coming after them. They're gonna come after them as soon as we're gonna get another stimulus package. As soon as we get that, and at the end of the year, and they release everything, they're gonna come after these guys, these loan servicers. They're gonna come after, and they're gonna be filing and kicking a lot of people out of their homes once this thing comes to an end here. We are literally just holding off a dam. In a few. Probably it's going to start 2020, moving on into 2021. If you got money, there are going to be a lot of houses on sale for cheap. I mean, the market all over the place, they're already dropping in prices, right? Even in places where we're not even used to price dropping, they're already dropping. People are selling for less than it is worth because they're trying to get out from underneath all of these property and the debt that they're under. So keep this in mind, guys. We are not in a good position. And looking at all these indicators that are out there, all these warning signs and these warning signals that we are not heeding, get prepared now because it's gonna get worse. It is going to get worse. They are telling you this in front of your face. You got to pay attention. Everyone wants to wait for the stimulus check. Everyone wants to fight for this, fight for that. This is what's coming. These banks are going to be in trouble. People can't pay their mortgages. People haven't had a stimulus payment in 6 months. They're going to extend forbearances till the end of the year. There are going to be a lot of people who are going to go homeless. So keep this in mind, folks. Start preparing now. And start watching this Deutsche Bank. Start watching these guys, because these guys, they are a bubble that is going to pop. And once they pop, all of this derivatives, all of these toxic assets that they owe, including some of them probably owned by you right now, are going to go bust. Mark my words. And that's all I got to say about that segment.